Hello everyone, Clifford Bennett, Chief Economist, ACY Securities. And what a roller coaster it has been. Some of you may have not picked up on it yet perhaps, but actually markets sold off in New York despite having a higher close. By that I mean the intraday price action, US equities actually went a lot higher than where they ended the day. And the rejection of those highs is a little bit of a first chipping away of that impenetrable bull pack. So they're looking a little bit weak in the knees at the moment. If the downside momentum builds, you know I'm a fundamental bear, but I have been saying all year that the price action is bullish, but fundamentally, eventually, this bull run will end. Very few of us knew how high this bull run would run, and it's been huge. But it's no bigger than some of the other rallies, many of the other rallies of 2022, where we saw stocks fall 20%. So, as I said recently in a TV show, I'm not as confident this year as I was January last year, where I said, yes, we're going to have a major correction, but I do think we are going to have downside. I do think the market is 180 degrees wrong, whatever it is, 100% wrong, in thinking that there's going to be a pivot. To me, it's a joke. So there's not going to be, the Fed's not going to be cutting rates this year. The market is, futures market's pricing in 50 points in rate cuts from where we are by the end of the year. And the Fed chair, Powell, is saying he let it slip at the press conference actually. The official statement said ongoing rate increases. And during the press conference, he went another couple, which is 2. So we know there's going to be at least 2, or that's what they're thinking now. And of course, they can always change their minds. But they're thinking another 2 rate hikes of 25 points after that one. That takes us to about 5.25%. Remember, my minimum target was 5.75. So we're going to get almost there. And then if there's any uptick in inflation, and that is not beyond the realms of possibility and not something markets are pricing in, there will be another further 2 rate hikes upon the 2 that we're going to have. So it's 50 or 100 points higher for the Fed funds rate. Futures are pricing in a 50-point decline, because they think there'll be a pivot. There won't. So the market's going to be badly disappointed in the same way that the market was badly disappointed in thinking inflation was transitory in the first place, because it wasn't just the chairman of the Fed saying it. Most of the market said it. And when I was saying, no, it's not transitory, people said, no, of course it is. So I think the market can be disappointed again on its fundamental view. Remember, at the start of 22, all the major banks were forecasting a boomer economic year. And stocks going through the roof. So that didn't happen either. Now this year they're forecasting a pivot. That won't happen either. Though I must say most of the major banks and senior economists aren't sort of forecasting a pivot. It's more the kind of people will have something to sell in the market, want to get you excited about buying. It's also some fund managers, and fund managers obviously have a bias. They always want you to think the market's going up, so you'll keep investing with them, because they're mostly long-only fund managers out there still, bizarrely. So if people are trading markets thinking there's going to be a pivot, think again, there isn't. The new jobless claims that just came out yesterday, another very low number, which means further fuel, ammunition, if you like, for the Federal Reserve to keep raising interest rates. Inflation is nowhere near where they want it. Now, much ado was said about, oh, the word disinflation was used in his remarks and comments. Yes, but when you hear people telling you that, they're forgetting to put it in context. He said, it's nice to see, but it isn't enough, and we're going to still continue to hike. But people wanted to just tell you the first part of the sentence. It's nice to see some disinflation forces. We all know there's disinflation forces because inflation has come down. It wasn't anything new. Everyone knows there's disinflation, but inflation is still way too high. And that's why the Fed, in their mind, thinks it's appropriate to continue to hike interest rates. So they're going to, because from their point of view, look, they've hiked interest rates all this way. It's not doing as much economic pain as they thought it would. therefore again further fuel ammunition to keep hiking rates. They're definitely going to do another 2 meetings, and they might even do 3 without an uptick in inflation. But if you get an uptick in inflation, then it becomes 3, 4, maybe 5. But I'm going to kind of stay with 2 and 4 on that basis, but it could be as high as 3 and 5. So, and when interest rates stop going up, because of course one day they will stop going up, that's not a reason to buy stocks either. I mean, laugh out loud, people are buying stocks because the Federal Reserve raised interest rates and said it's going to keep raising interest rates. Hilarious stuff. It's like meme trading has come to the mainstream. Absolute nonsense, but it's called exuberance. It's called greed and over-exuberance. It's like what you usually have when a market's making new all-time record highs. Everyone's so excited and buzzing that everyone just wants to keep buying. And that's what's been happening over the last month or so with the US stock market. It didn't matter what came out, it was spun in a positive way to buy. So financial media has a lot to answer for and all of that, by the way. So it can't go on forever. But how far can the elastic band stretch between reality and this false sentiment? Probably a long way. We're certainly seeing that. But the further it stretches, the bigger the eventual fall. So just be wary of that. We've started to see the first chipping away of that bull market rally that we've seen of late. Because let's face it, all the bullish spin is out there in the market now, and the market is stalling, falling back in on itself a little bit. That's all a little bit worrying. All right, just remember you can go short markets and continue to protect your investment portfolio in that way using various financial instruments that are available, if that is your view as well. Thanks very much. Clifford Bennett, Chief Economist, ACY Securities.